My name's Remco Marcelis. I'm a partner with Standard Ledger. So just a bit of background on me. I've been the CFO of a bunch of startup companies, both historically and now, and also on the venture capital side. These days, I hang my shingle out as the managing partner of Standard Ledger, as well as do some virtual CFO services. I also believe a lot in education, which is why I'm helping out with Fifth Institute. So I'm General Assembly's financial presenter, both in Melbourne and Sydney. Giving this today from Sydney, in fact, but most of the time I'm based in Melbourne. So what do you need this, right? Mike Cannon-Brookes, one of the doyens of the Australian tech industry, I had to grab this pull quote. He said, developers should do some accounting, right? But well, seriously, why? Right? So startup founders and developers. So you're building your products and your ideas, you're doing all your marketing, but at the end of the day, you really need to get the language of business, which invariably comes down to numbers. You got to understand what a profit and loss is, a balance sheet, even debits and credits, right? It's kind of how you keep score, right? So I give another topic, which is more about some of the jargon of accounting, which we might choose to do another time. We'll talk to Dan and Bambi about that. But today we're going to go through really the kind of things you need to think about when you're starting your business, and then kind of first stage of how you manage it, at least from a financial perspective. What are the things you need to think about? All right. So when you are starting your business, yes, there's people like myself, accountants and lawyers that you can turn to for advice, and by all means, reach out if you've got some questions. But I'm also a big fan of just talk to other startup founders, right? People that have done it before, right? Don't just talk to us accountants. And by the way, I struggle to call myself an accountant. I'm very much an operational CFO, so I've been in the trenches with a bunch of startups, as I said. But talk to those people that have done it before, as well as the professionals, and try and get the well-rounded picture. The government, as always, is here to help you, as I say. And there's a bunch of resources, both at the federal level as well as the state level. Believe it or not, the ATO is there to help you. They even have videos on their websites now, very 21st century. So there's a bunch of resources that you can go and look for from the ATO. And if you go to business.gov.au, you can go starting a small business, what do I need to know? All right. So they have checklists of the things you might need to think about. And yeah, I've unashamedly borrowed some of those today, but also reach out and have a look at those websites as well. So the kind of things you need to think about. What's the structure of your business going to be? You've got to create an entity, and we'll talk about what that means in a moment. You may have shareholders if you're a company, right? And how do you hold your shares, right? You may have multiple shareholders and need to reach an agreement between yourselves, right? Register your business. It might be a business name if you're operating in your own regard. There's a bunch of boring acronyms you've got to know. ACN, Australian Company Number, ABN, Australian Business Number, TFN, Tax File Number, GST, BAS, etc., right? And then if you're employing people, there's another whole world of compliance and pain that goes with trying to manage that stuff. So let's have a look at a few more of those things. So the kind of business structures you might need to set up. When you're first starting out, most people are often doing it as a freelancer. They're doing stuff on their own. In technical terms, the tax office calls that a sole trader, right? The next step up from that is to create a company where you're bringing together one or more people to build something of value. And both of those two I'll go through a bit more in a moment. And you might also hear of establishing a partnership, right? So as an example, Bambi and I might establish a partnership to pursue a business together. But the way partnerships work, they're a bit weird, right? In that, let's say I go and do a runner, right, and incur a bunch of debts, right? And then I leave Bambi to pay for all of those. The partnership means you share both the upside and the downside, and I personally find them risky. And you very much want partnership agreements wrapped around some of that for the downside. You might also hear of running a business in a trust. I'm going to spend time talking about sole trader and company. If you want to talk about the others, by all means, reach out to me or another accountant for the relative pros and cons of partnerships and trusts. So as I said, quite often when you're first starting out, you start off as a freelancer, a sole trader. So you might be doing graphic design on behalf of someone else, or while you're trying to get your own business idea up and running, you decide to quit your day job to give you enough focus and do some consulting for a while, right, in your own right. So the important thing here from a tax perspective, and sadly we're going to talk a bit about tax today. I am an accountant after all, and you do need to know some of this as a business owner, right? So as a sole trader, when you get taxed as an individual, as yourself. So let's say you've got your day job, right? You're earning some money from your employer, and then on the side you start to do some consulting or freelancing of some kind. What happens in your tax return is not only do you report all the stuff that you're earning from your employer, less deductions, and you get taxed on that. There's a whole separate schedule in your tax return called a business schedule, right, where everything you do in your business ends up added or subtracted from your overall earnings, and then you get taxed on that. So if you are on that little table you see there on an $80,000 salary, you'll get taxed at 37%. So if you start earning more on top of that, it all gets taxed at that sort of level. So yeah, sole trader, taxed as an individual. You do want to do this thing called an Australian business number, right? You can register as Remco, right, individually, and apply for an Australian business number. There's some links down the bottom for doing that. In theory, you don't have to, but if you don't, you're just going to get charged with that top tax rate. So it's really non-negotiable to my way, unless you want to pay the government lots of tax. As a sole trader, one of the things that often comes up is, do I need to register for GST? So you have to register for GST if you're earning more than $75,000 or expecting to in a year. And so, that's a hard threshold. You have to do it after that stage. Some people choose to register before that in any case. And some of the reason is, if you are a freelancer, you're providing services in your own name, and you send an invoice to a larger company and you don't charge GST, they know that you're earning less than $75,000, right? So sometimes it's a perception thing. You might not want to appear quite as small as you may genuinely be when you're first starting out. So some people register for GST just so they hide the fact that they're small, right? The other reason for registering for GST is you can get GST as cash back. So let's say, and it's particularly useful for startups, let's say you're earning a bit of money, right? Either as a sole trader or as a company, it doesn't matter. But your expenses when you're first starting out are far greater than your revenue. A not uncommon scenario for startups, right? So if you are registered for GST, let's say you spend $10,000 on getting some software services done, plus $1,000 of GST. And let's say you earn no revenue, right? So if you register for GST, that $1,000 of cash that you've spent getting your software built, right? You fill in the right paperwork called a business activity statement, and you get the $1,000 back as cash in your bank account. And again, when you're all starting out, cash is really important. So there are a number of reasons why you may still want to register for GST, right? Even if you're not at that revenue threshold. Cool. So that's as a sole trader. So then you start thinking about, well, when do I become a company? So the most common kind of scenario when people get to this stage is you get two founders, quite a common scenario. They're each in their day job. They're doing some stuff on the side of their day job. They're not quite ready to quit their day job because it's paying the bills, right? But they've built some software or got some early traction of some kind. In essence, they've got something of value that they've been working on for a while. So to me, the point at establishing a company is when you get to that point of saying, hey, I've got something of value that we've both contributed to as founders. How do I hold that value, right? And that's the point at which you put it effectively into this shared vehicle called a company, right? I'll go through a couple of other reasons why you might want to set up as a company in a moment. But for me, that's kind of the number one defining reason of when you create it. You might still be in your day job, right? And still trying to grow some sales on the side in your new company, right? But at that point, you're starting to generate revenue. You're starting to have some software, then do it. Some people get hung up on tax rates. Create a company because the company tax rate's 30% and my individual one's 37%, right? So I'll pay less tax if I'm a company. All right, let's go through that. I'll quickly go through a worked example of that just to work through it. So when companies make profits, right? Let's say you sell some stuff, you spend some stuff, and at the end of the day, you make a profit, right? That profit, right? You can decide to keep all that cash as cash in the company and you reinvest it for the future, right? Or you can choose to share that profits with the shareholders. So the shareholders are the ones that own the company, right? The founders, right? And those profits, as they're shared through the company, right, come to the shareholders and are taxed individually. Sorry, I should have put that through. So the company itself is taxed on profits. And then, when profits are shared with founders, right, there's a mechanism in there called franking credit. I'm not going to go into it in detail, but that's to avoid getting taxed twice. But essentially, dividends flow through to shareholders and are potentially taxed again. All right. So profit flows as dividends through to the shareholders. The other way that stuff flows through to shareholders is, let's say you're building a startup company, your brand new company, and you go and sell it to Google for $1 squillion, right? You've made some money, right? When you've done that, that's what they call a capital gain, right? So the company was worth effectively nothing, right? When you started, it's worth $1 squillion when you sell it to Google. That profit between 0 and squillion is taxed at capital gains rates. So if you start to be in a company, right, you'll hear more and more about the capital gains, right? What we do recommend, right, let's see if I can, it seems a busy slide, but I'll work my way through it. When you're starting a company, what we recommend for 95% of companies is you own your shares in a trust. Now, it seems like a complicated thing, but let me break it down for you. So we just heard that if a company sells to Google for $1 squillion, right, the capital gain goes to the founders, right? Yep. So back to that slide, the shareholders. So you will get taxed on it if you are the shareholder in your own right, at whatever your tax rates are. What we recommend is that you hold your shares in what we call a family trust. So think about a family trust as like, let's say when your great aunt Mabel, hopefully none of you got one of those, but she dies, right? She dies and she leaves an estate and there's an executor appointed, right, to that estate, right? The sole purpose of that executor is to distribute the proceeds of what is in that estate to the beneficiaries. That is a trust, right? And so the same exists for if a startup company has its shares held in a trust, right? It can distribute it to any other family members, and there's a really broad definition of that, right? And more importantly, you can change who you distribute it to on the fly, right? So imagine, all right, you held all your shares, you sold it to Google for $1 squillion. You can then decide, I'm going to pass some to Frank and John and kids and other trusts and other things. You've got ultimate flexibility in choosing it. There's costs associated with it. You've got to pay accountants, sadly, to do tax returns, and there's a setup cost in it. But that's the trade-off you're making. If you're trying to grow your startup for future, right, and allowing for that flexibility of some unknown future event, we thoroughly recommend you do a family trust. By just get it out of the way. I think there's a $440 family trust set up and a $250 tax return. That's kind of the cost you're up for if you want that flexibility in the future. Having once got your family trust holding your startup company, you can use that family trust as effectively an investment vehicle then for other startups. We're all curious creatures, us startup founders, so we tend to do a few things, right? You could even hold your investment properties in it. So it truly is a family kind of investment vehicle. So on structures, not only do you think about the company itself and the shareholding in the company, but also what you hold your shares in. So I just want to come back to the myth, if you like, and we're going to do a little bit of tax. And there's warning ahead, there's lots of numbers, right? But by way of example, so some people get hung up on, I should be a company because it's lower tax. Not necessarily. So at the top, I've got an example of if you're a sole trader, like an individual, you're earning $100,000 and spending 80, or earning 100,000 and spending 50, or earning $200,000 and spending 100,000. Hopefully I've done the numbers right, but in those three different scenarios, right, as a sole trader, right, what you'd end up with is cash in your hand, right, that's net profit after tax, right, cash in hand, right? That's what it's all about, of 19 grand, 41 grand, and 73 grand in those scenarios. Let's say you chose to do exactly that same business, but do it in a company, a small business, right? It's less than $2 million. The tax rate is slightly lower again, right? On the face of it, it says we're going to pay less tax, 14,000, 35,000, 71,000, a little bit less, fine. It comes at a cost of paying accountants to do tax returns, right? So you might want to decide whether you're really up for that. Because as a sole trader, you can still do your own tax return if you want to. For the couple of grand, you probably end up paying that to accountants, right, for the benefit of it. And then there's a whole question of how much of that profit, again, I'm not going to go through all these numbers, how much profit, right, that you get taxed on, because you might not distribute all of it out of a company that can affect it. So I just want to make the point, the decision to set up a company is not about the tax, right? It's an outcome. You choose to run a company for a number of reasons. One of the other reasons that often comes up for running a company is if you've got a product, particularly a physical product, or you're providing a service like me, an accounting service, professional service, right? Someone decides to sue you, right? Your product, your widget fails, or I give you bad advice, right? You can sue me, right? And if I was providing you those services in my own name, you can get insurance for some of this stuff, by the way, but it's layers of protection. If you were to sue me in my own right, I was providing those services or selling those widgets, right? If I had a property, you could sue me for my assets, my houses, if I wish. But all of that is exposed, right? If you operate through a company, right, you limit the liability to the assets of that company. So there's an inherent protection. So some people choose to set up companies, right, even if they're effectively a sole trader, right, just for a layer of protection based on what they think are risks in their area. So depending on your business, you might want to think about that. If you're on the path of building a startup that's going to raise equity, you just can't do it. Back Remco, you can't get a percentage of me, right? You've got to get a percentage of a company. So that's again a reason. If you're doing R&D, research and development, and you want to access the government's R&D concession, so we provide those as services. So you're doing R&D for a year, you'll want to get 45 cents on the dollar back, which you can do. Spend 100,000, get $45,000 back. You just can't be a sole trader, simple as that. You have to be a company. Right, so they're all positive business reasons why you would be a company, as well as that, hey, we've just got to have a vehicle for holding the value. And income splitting, we talked a bit about trusts, how you can do that on the event. So that's the structural kind of stuff. So very much, if you want to create a company, go onto the internet, go create a company, right? And you'll find any number of companies out there. So and very much I want you don't have to pay lawyers and accountants for stuff, right? Unless you need advice, right? Or some peculiarities, which I'll talk about. But if you want to create a company for yourself, or you and another business partner, you can go online, you fill in all the details, bang, right? $749. I looked at it earlier. That's just a number as an example, right? You've got a company, and you've now got this thing called an Australian company number. Yeah, there's that first acronym. Right? Don't have to pay lawyers and accountants. I'll say that again. Right? But, right, if you want to be on the path where you want to start getting investor ready, right, where you've got a couple of founders, right, that you might want to do things with in different ways. You've got investor, or you're getting it ready for investors to come in. Invariably in those cases, right, there's a thing called a shareholders agreement that defines some of the rules between the shareholders, above and beyond what you get if you just go onto the internet, right? So at that stage, you go, right, I need to think my way through and probably talk to a lawyer. Full disclosure, these are our lawyers, but our business partner lawyers, sister company, General Standards. I'll just give you a sense of some of their pricing. It might not be quite up to date. I can't remember when I grabbed the picture, but it at least gives you something to compare to if you're talking to other lawyers as well, to get a sense check. There are all the kinds of agreements you might need in place above and beyond, but particularly that shareholders agreement. All right, what are the other things you can do for yourself? All right. As well as being a company, you've got to still register for this thing called an Australian business number, right? You've still got to register for a tax file number. So if you're operating as a sole trader, your own tax file number is your tax file number. If you're a company, you'll need to apply for an extra one, right? There's acronym number 3 we're up to. Goods and services tax, GST, I already talked about, right? You also have to register for that. And yes, you now collect tax for the government once you're registered for that. Well done. You may want to register a business name. So, we're called Standard Ledger, right? That is our company name, which suffices. But let's say I was a sole trader, I could still hang my shingle out as a business. I could be Remco, trading as Remco's accounting services, right? So that trading as business name. Sorry, my screen is ringing. If you need to have a name that is different, right, than your own sole trader name or own company name, you also need to register the business name, right? And if you want to protect that, right, as a trademark, you've got to register that as well. So there's layers of stuff you may want to think about, and that's the purpose of today's session, just to help you think through some of the things that you might need to think about. As I said, when you hire employees, you're in a whole nother world of compliance. I can see Bambi nodding. So all of us have been employees at some stage. Those pink piece of paper you get when you join a new firm. If you are that startup, if you are that employee, you've got to get very used to being both the employer and the employee, and sometimes the shareholder, and sometimes the trust. Multiple hats, right? But all that stuff, when you were just an employee working for someone else, if you now are the employer, you've got to think this stuff through for sometimes just yourself, but definitely for other employees. So you need to make sure that each employee has a tax file declaration. All that tax that gets taken out of your pay as an employee, right? If you're the employer, you need to make sure you take that tax and you collect more tax from the government. Oh, and remember to pay the tax department their money, right? When they want it. It's not yours to keep, right? Bad. Right? Because you're an employer, right, you need to put in place workers' compensation insurance if someone falls over and hurts their finger or something like that. Right? You need to make sure you pay the superannuation quarterly that you're paying for your employees. You need to make sure you issue all that paperwork to your employees at the end of the year. You need to have contracts, etc., etc. So there's quite a lot to think about if you become an employer. Right? Once again, jump onto both the federal government site and the Victorian business government sites. They've got a lot of this information up there as well for you to think about. And I'll just jump for a moment ahead. I'll skip a couple of slides. So all of that was talking about getting set up. Now I just want to talk a bit about how you might want to manage your business. So once again, courtesy of our friends at the ATO, they talk about the records you need to keep, right? So let's say the tax department comes and audits you in a couple of years' time. They'll say, thank you very much. Where is this invoice? Where is this evidence? So you do need to keep records. I'm not going to go through them all in detail, but you know, there's a list of the kind of things you need to think about depending on the kind of business you're in. I broadly go anything with a signature, keep a copy of, right? By the way, we're a weird accounting firm. We don't do paper. Everything's electronic. So you know, take pictures of everything, you know, file them up on Dropbox or Google Drive, you know, but just keep a copy of it, right? And by the way, if it's up in Google, of course, it's searchable. Right? It makes it easy. And you know, it's perfectly acceptable to say I've booked a flight on Virgin or Qantas, and the ATO says where is that invoice, right? And you can go into your mail and go, here's the itinerary, here it is. Right? Your obligation is just to be able to provide it. And even at the early stages, so we're talking about managing a business, right? The kind of things you've got to think about, right? You've got to track your finances, right? So you got to worry about all that compliance stuff, you know, giving the tax department their money and stuff like that. Try and set some budgets for yourself, even in the early days, and then you know, look at how you're going to manage the cash. So there's products around like Xero, which we use exclusively, right? Make it really easy to track your finances. So a bunch of our clients, we just set them up and off they go. They look after themselves after that, right? But what you want to do is just start to be able to, you know, look at your numbers, right? As well as build your product, etc. So you can, again, do that yourself, sign up. We offer a full bookkeeping service if you need it once you're ready for that. I've just got there a link to Xero itself, or you know, Google them and you'll find it. You can look at that afterwards. So when you're tracking your finances, right, very much the things you once you're set up in, say, something like Xero, right, you need to record your customer invoices. Hopefully you've got customers, right? So you want to send invoice and do the work, send invoice, collect the cash, right? These are the things you need to worry about. So send invoices, right? As soon as you do the work, send the invoice, right? You've earned it, right? Track the expenses. If you've got payroll, there's a bunch of tracking and reporting that you need to do that, including back to our friends at the ATO again. You want to manage your cash. You know, I work with one company founder that's been going for 20 plus years. The way he manages his cash, he checks his mobile phone. What's in my cash? What's in my bank account? That's okay. But what about knowing that you've got to pay the ATO once a quarter their money, right? Do you know that, right? Are you tracking whether your customers are paying you or not, right? Are you following them up? Are you paying your suppliers? It's good to pay suppliers, you know, pay them on time, and that way, you know, sometimes if you need their help by extending things, right? If you've looked after them regularly, they'll extend you some credit as well. So very much I go, you know, every week, check the bank, that's checking cash, all good. And then just once a month, right, at the very least, just, you know, take stock, look at how your business is going. Part of the other reason we like registering all our startups for GST is that because you have to report to the government once a quarter, right, it forces you at least once a quarter to take stock again, right? And again, that's a good, you know, benefit of doing that. But ideally, right, you're looking at once a month or possibly even once a week on how you're going, right? So send your invoices, follow up what's outstanding, collect the cash. Have I said that often enough? Collect the cash, right? One of my clients, their customers are builders. You know, they're a shonky lot. Sorry if any of you are builders, but they can tend to come and go sometimes. And so we make sure that we've got a whole escalation process in place. You know, every week they get an increasingly, shall we say, nastier letter, right? Or email saying, we've done the work, please pay us our money. We've done the work, really pay us the money. We've done the work, you know, we're about to send you to debt collectors. Oh, by the way, you've gone to debt collectors, right? So you may not have builders as clients, and you may not want to go there. But fundamental thing is you've done the work, which is why you sent the invoice. So you're owed the money, collect it, all right, and just make sure. No one likes doing it, no, but I like running out of money even less than I like asking for money. So, what's a valid tax invoice? That's I won't bore you with that. Managed cash, and then the compliance stuff. Just to kind of circle back around, right? So we actually, set up with clients, a whole calendar of here are the things that I may have to do, by week, by month, by quarter, by year. So you've got to, both report and pay money, either annually, quarterly, or monthly for GST through this thing called a business activity statement. Same with the tax you've taken out of the employee's pay. You've got to pay the ATO. ASIC decide that they want to charge you just to, look at your books once a year. And you've got to pay work cover and superannuation when they. So there's quite a lot of moving parts you want to think about. But as long as you've got yourself a calendar, just set up a spot in your Google Calendar saying, once a month I've got to do this, once a quarter I've got to do that. Note to self. I've got a slide in there that just talks about how GST works, which again I just borrowed from the ATO website. But just to if you want to go back and have a look at that, the GST you have to pay is the difference between what you've charged your customers and you've collected and what you've paid to suppliers. So you don't have to pay the whole lot. And as I said, if you're spending more than you're earning, at least you can get the cash back if you're registered for GST. I wouldn't be doing the right thing if I didn't mention the budget word, right, as a finance person. Right? And it's all a guess, right, when you're first starting out, right? So I don't know what I'm doing next week half the time, let alone in years from now. But you get better at it, right? So very much when we're looking at budgets, I come back to how do I want to run my business, right? I'm going to spend some stuff, right? I'm going to do some marketing. Okay, well, put $1 attached to that. Right? How much am I going to allow for Google AdWords or Facebook advertising, right? I'm going to build some technology. Well, I might be able to borrow something from Dan there. I'm going to peg you, Dan. You're going to build my code for me, right? But I'm going to have to pay him, right? Or you outsource it, you're going to have to pay for it. So they're the kind of the expenses side of things. So you should, hopefully have a plan of how you're going to spend some money, right? And then hopefully have that money to spend, right? You got to raise it from somewhere. Revenue is always the interesting one, right? So, so how do I know? So I can spend money. That's easy to do, right? But how do I know how much that's going to convert to revenue? So we also try and break down what are the activities you are doing to bring that money in. So if you are Facebook advertising, all right, so as well as the expense, how much do you expect to convert from that advertising? Maybe you need to do some little tests first, put some advertising out there. For a couple of $100, you can put up Google AdWords or Facebook ads and test, see how many people care. Some clients have got a fake website, right? They just put up just for testing purposes, right? They go, hey, I need to target all the Chihuahua owners in the south of Sydney, right? You can target stuff like that and then send them to a website just to see how much demand you might be able to generate. With a landing page that says put your email here. It is still always a guess, right? If you're the kind of if you're a SaaS company, software as a service company, you sign people up to your website, they sign on to a trial, then how many people go for a trial, right? How many people survive to the end of the trial and then sign up to pay, right? You're still trying to guess that, right? We've all signed up for stuff or downloaded apps that we've never used, right? So downloading or signing up is the first part, but you've got to really think about how you're going to coach people through that buying decision. So all I can suggest in budgeting, so that was a long discussion on that, is try and think through as closely as you can what's your plan. And then I go plan drives numbers, right? So try and then, once you've got a plan, put some numbers attached to it. So as well as your typical accounting types of reports, they call it a profit and loss. I like to say it answers the question, how much did I make or lose, right? A balance sheet you'll see there on a menu in your accounting software. what it's really saying is, what am I worth? What's my company worth at a point in time? A cash summary is pretty self-explanatory. How much cash do I have? Where did it go? Also encourage you to look at what your customers owe you regularly. That's that whole thing of collecting it. And what do I owe suppliers? I encourage that once a month. When we do reporting, right? Also, and I'll just show you different versions. There's no absolute rights or wrongs. If you're the kind of business, in this case, as an example, our clients were, our target customers was retail stores. So that was a key metric, a key driver of our business. So as well as tracking the finances, right, I tracked how many customer stores we'd signed up. What's your key metric? And report your metrics right against your finances every month. There's tools around like Spotlight Reporting, which we use that make pretty graphs. Right, and I kind of say that as a throwaway line, but it's far easier to get a handle on this as a graph than as a sea of numbers. So you may want to think about that when you're ready. And just again, some examples of different ones. And cash flow forecasting, right, is a really important thing. As I said, if you in once a quarter you've got to pay money to the tax office or pay superannuation for your employees. Right, you really want to have a bit of a forward view on that. So try and do as best you can, right, to look at your forward cash, knowing that often it depends on how much cash you get in the door from customers. Some classic startup metrics, what's cash burn? Cash burn is how much you're spending per month, right? So if you have $60,000 cash in the bank and you're spending $10,000 a month, your runway before you're dead is 6 months, right? So it's not a problem running out of money. It's just a problem running out of money without enough time to do something about it, all right? So, if you've got 6 months to live, well, you better, get you some focus, right? You can reduce your burn rate, right? Get more cash, right? Sell some more stuff. And then depending, this is just an example, again, of a different kind of metric. If you're a monthly recurring revenue SaaS business, there's a bunch of metrics that are relevant to that. And that's really it, guys, right? So going through setting up your business and some ideas on